If you've ever told yourself, I'll start investing when I have more money, or I'll do it when I actually understand how it all works, or honestly, I'm just too scared to mess it up, this video is going to be exactly what you need to hear. Because I've said every one of those things, and I'm a finance student with a lot of student loan debt, and I still let all of these myths hold me back longer than I should have. So today, we're going through the 3 biggest myths that I see keeping people from building real wealth, especially early on. And by the end of this video, you'll know exactly what to do instead. So let's get into it. A quick note before we dive in. I'm about to graduate with a degree in finance, and I love learning about personal wealth. And I still believed all 3 of these things at some point. So this isn't about judging where you are. It's just about giving you a clearer picture. Myth number 1. You need a lot of money before you can start investing. And I get why it feels that way. When you hear the word investing, your brain probably jumps to Wall Street, people in suits making millions of dollars. That's not us. Not yet, anyway. But here's what's actually true. Most major brokerage apps today, like Fidelity, SoFi, and Robinhood, they have $0 account minimums. You can open an investment account right now with nothing in it. And through something called fractional shares, you can invest as little as $1. $1 can buy you a fraction of a share of an index fund, which we'll talk about in a second. The real reason this myth is so damaging is because it's not about the amount. It's truly about time. I remember learning about it and being scared to lose money because it just felt like gambling. When I first started, I only put in about $50. For full transparency, I decided to try to find my earliest investment. As you can see, I only bought 2 of this US dividend ETF, and it took me almost a year to buy 2 more. This shows the uncertainty that I had as well. But I did, for some reason, buy Instacart on their IPO. Anyways, back to the video. I didn't even talk to anybody about investing at the time, and I felt embarrassed by how small of an amount I put in. But the point is, I started, and that's all that matters. The myth makes you wait for this right amount that never quite arrives. The right amount is just whatever you can do today. Myth number 2. This one honestly kept me stuck for a pretty long time. The myth is that you really need to understand how the stock market works before you put any money in it. And I think this one comes from a good place. You don't want to make any mistakes with your money. That makes total sense. But here's the thing. The financial media, the ones creating the news, and these investment apps, they're all designed to make it seem more complicated than it truly is. Because that complexity keeps you engaged. It keeps you asking questions. They make it complicated so they can make money off of managing your money. But if you know just the basics, you can do this yourself. The simplest investment strategies have historically outperformed the most complicated ones. So let me give you one of these concepts that changes everything. Index funds. Index funds do the understanding for you. They track the whole market so you don't have to pick specific stocks. An index fund is basically a basket of stocks that automatically tracks a market index like the S&P 500. When you put your money into an S&P 500 index fund, it's like you're buying a tiny piece of 500 of the biggest companies in America. All of them in one single purchase. You don't have to pick winners, you don't have to watch the market every day. You're just buying one piece of the whole thing. The S&P isn't perfect. It has had bad years, really bad years, but it has recovered every single time. You don't need to predict when it goes up and down, you just need to stay in it. Waiting until you fully understand the market is almost like waiting until you understand every traffic law before you learn to drive. You learn by doing. And with an index fund, your very first move is a solid choice. And if you remember nothing else from this video, remember this. The S&P 500 index fund, consistent contributions to it. Don't touch it. That's honestly like 90% of what you need. Okay, myth number 3. And this one is a little bit more nuanced, but stay with me. The myth is that you shouldn't invest a single dollar until all of your debt is paid off. I totally understand where this one comes from. There are a lot of popular finance voices out there that preach a debt-first approach. And honestly, for some people who are in some serious consumer debt, that advice makes a lot of sense. But it gets repeated and thrown around as this universal rule, and it's not. The question really isn't to invest or not to invest. How you should really decide where you put your money is based on interest rates. An easy rule of thumb, compare your debt's interest rate to the market's average return, which sits about 7%. You can categorize your debts into high interest rate and low interest rate. If you have credit card debt that grows at a high interest rate, like 15, 20, or even almost 30%, you should definitely pay that down before you invest. Paying off that 20% interest debt is a guaranteed 20% return on your money. You can't reliably gather that high of a return from the market, so in this case, the debt wins. But for other debt, like federal student loans, most of those sit between 5 and 7%. At that rate, the math often works out in favor of doing both. Continue to make your loan payments while investing at the same time, because those long-term investment returns can realistically match or even outpace the interest rate on that debt. There's also one exception that I think everybody needs to know. If your employer offers a retirement match, meaning that they'll match a percentage of what you put in your 401k, You should definitely always contribute enough to get that full match. Walking away from that is like leaving free money on the table. Don't do that. Personally, I have student loans that sit at varying percentages, but I still made the decision to do both. I'm working on paying down my highest interest loans first, but I'm also prioritizing investing in my Roth IRA. And all the investments I've made in my brokerage account before now, I'm leaving them in there. Everyone's situation's different and your numbers look different. Again, I'm learning here too. But right now, this is what makes sense for me. The bottom line is this myth treats all debt like it's equal. That's where it goes really wrong. First, take a look at all your interest rates, make sure you get the contribution match if that applies to you, and make the decisions that fit your numbers. Don't follow a blanket rule that someone made up. Before I wrap up, I want to give you something specific to do. Not someday, this week. If you don't have an investment account yet, open one. There are a bunch of apps out there that are very beginner friendly. I use Fidelity, and it only takes maybe 10 to 15 minutes. And you don't even have to put money in right away. Just open the account. That first step is the biggest psychological barrier, and once that's done, everything feels a little bit more possible. If you already have an account but you haven't invested in anything yet, search for VOO or FSKAX. Those are two of the most popular S&P 500 index funds. Put in whatever you can, $5, $10, it really doesn't matter. Just getting started is what matters. And if you're already investing, just make sure your money is actually in a stock and not just sitting as cash in your account. I know it sounds obvious, but you'd be surprised. A lot of people will open the account, deposit the money, and forget to actually buy anything. So then the money just sits there doing nothing. Just go double check. So, just to recap, you don't need a lot of money to start. You definitely don't have to be a market expert, and you don't need to wait till every loan is paid off. What you need to do is just start. Start on your terms with whatever you have right now. If this helped you, subscribe. Consider watching my latest video about why a Roth IRA might be the most powerful financial tool that most people are sleeping on. Drop any questions you have in the comments. There's no question that's too basic here. That's kind of the whole point of this channel. I believe in you. We're gonna figure out this money thing together.